Why did the stock market go up today? What caused it to rally? Actually, the last few days as I record this. So we're going to look at it. And actually, it's a follow-up to a series that I've been doing recently. I will put the other, I think there's 3 or 4 previous videos on this topic where I was talking about the market bottoming. So I will put the link in those links in the description below. You can check those out. But might as well watch this one first while you're here. So a couple of things. First thing I'm going to start out with is picking up where we left off in the previous video so that we have some continuity there. And then I'm going to show you the catalyst for this. The reason in my previous videos I was looking for a bottom and talking about that was this index right here. So as you can see, this is the S&P 500, the percentage of stocks above the 50-day moving average on a daily chart. And as a quick review, these numbers over here represent the percentage that are above it. So the smaller the percentage, the more we are looking to buy, actually, because it means that it's an exhaustion pattern down. And we've seen this in the past. Way back here, October of last year, we'll compare that when it got really low. Here, got really low. And then here, now, by the way, that's this index up here. This is an index, not an indicator. Now at the bottom, I have the actual S&P 500. So here I'm plotting that. So you can see the price action of the actual S&P 500 and how it correlates to this particular index. So it's a technical analysis approach. So the first time that I brought your attention to it was when we had this low here. All right. And so I did go ahead and I bought some out of the money calls here. And in one of the videos, I showed how I made 70% on that. And then in one of the other videos, I talked about what we have right now, which is a divergent. And now we have it with this rally, with the market going up. So if you look at this last time, we had this dramatic difference. We had a higher low on this index, but we had a lower low on price. So divergence. And now we've got that same thing. On the index, we have, so this is the update. We have the higher low on the index and the lower low on the S&P. So I went in and bought more out of the money calls here. And so far, so good. Now, another thing is that it's the same time of year, and this does have a historical basis. So if you could see here, October, we're right there again right now. So I'm recording this on November 3rd, November 3rd. So what this means is we are into this historic time of year. There's actually 2 things here. Historic time of year when the market normally gets most of its gains from right after Halloween all the way until May, and then they say May go away. And according to the Trader's Almanac, over many, many decades, the stock market has gotten the vast majority during this period of the year, of the cycle. So end of one year and then until May of the next year. So we're smack dab, we're right there right now, very timely. Another thing is the 4-year cycle. So we just happen to, of course, be in the 4th year of the presidential cycle now. And of course, what happens there is a very well-known cycle. The president and the political powers that are in control, they want to make sure that we have a good stock market year, so everything looks great, and they get reelected. So they do everything in their power, the theory goes, to make sure we have a positive year in the stock market. So that's another thing in our favor right now. And then finally, this is technical analysis. We've gone to some historic analysis, and I'm going to finish off now with number 3, which we call a catalyst. And the catalyst is the news. And the news is this. Here it is from the CNBC website. This is the FOMC day, which was Wednesday, November 1st. And I'll just highlight a couple of things here. So the FOMC, the Federal Reserve, they decided unanimously to hold the key fund rates in a target range. All right. And so that is amazing because, well, when I say amazing. That the market loves that. The stock market loves this. So FOMC meeting, probably that, and the CPI. There's other reports as well, but these are the FOMC is like the biggest economic news that the stock market pays attention to. And then also it shows a pattern. So it wasn't just this time. This was the second consecutive meeting that they chose to hold. And that's after 11 rate hikes. So the market really loved to see this. Okay. And then they also included, and so people not only look at the number and what the Fed decided to do with interest rates, but they also look at what they say. And it included an update or an upgrade to the committee's general assessment of the economy. So there's usually two things that happen. People, number one, they look at, okay, what was the decision? That's just called the FOMC decision. Got to raise rates, keep them the same, or lower them. So that's step one. And then two, what do they say in the report? And so you almost have two catalyst events, as they're called. And both were really great. Okay. And then there was one more that came out the next day. I'm sorry, this one actually came out today. So here's Reuters. And so here it says, okay, the stock market rallied as bond yields fell sharply. So why is this important? It's because, and really the most important market, financial market in the world, is commonly accepted as the bond market. When interest rates are high, then people tend to move money out of the stock market and into interest-bearing financial vehicles because they can get a good rate of return without the risk of the stock market. But when interest rates are low, then they can't do that, and so they go into stocks, but they're riskier. And that is the playoff between these two. So now, that's what people are looking at. Bond yields, when they fall, that's like, oh, God, I can't make any money with interest rates anymore, so now I'm going to move money back into stocks, and stocks go up. This is a meta pattern that we see. And, of course, that had a catalyst behind that, after data showed signs of the slowing of U.S. jobs growth and an uptick in unemployment, boosting, now that doesn't sound so great, right? But boosting hopes that the Federal Reserve is done with this interest rate hiking campaign. So this is where you have to look at the news and say, wait a minute, signs of slowing U.S. jobs growth? That's not good. Uptick in unemployment? That's not good. But as a trader, the way you have to think about it is, oh, so then how is the Fed going to respond to that? And the thinking of the people who participate in the stock market is, oh, well, then probably the Federal Reserve is going to be done with interest rate hiking in the future. So we've got two meetings now where they haven't raised rates, and now the market is saying, oh, and we don't think they're going to in the future either. So if you found this helpful, go ahead and subscribe to the channel. We're trying to build up our subscriber level so we can get this out to more people. I give away a lot of free content. And, I also give away my free market timing indicator. We'll talk about timing today. So get my market entry timing indicator. Just go to indicatorwebinar.com. There's a little free course there. I actually give you the information on how to set up the indicator in your charts and how to trade it. So how to trade is very critical. And like the video, I'm very interested in your comments below. Please leave some comments or questions or any topics you might want me to cover in the future. That's how I actually choose topics, is based on what you ask me to do. Either put it in the comments below or send me an email, and that's how I choose what I do in videos in the future.